Two forces are colliding in 2026 global economy, and one of them could destroy your portfolio while the other save it. This is the 2026 Global Macro Outlook, a multidimensional polarization, navigating the collision of geopolitical shocks, 5.2% yields, and the relentless AI supercycle. Let's go into this. Here is the full picture, the great collision. Four forces hitting simultaneously. Two bearish, the Hormuz closure crushing energy markets, and 1.2 trillion in the consumer debt getting crushed by 23% APRs. Too bullish, 5.2% yields are bad for borrowers, but the AI supercycle is driving 13 to 14, 15% above trend market. Above trend earnings growth that's single-handedly holding markets up. These four cycles colliding right now. Let's break each one down. The Hormuz checkpoint. Iran closes the Strait of Hormuz, 20% of the global oil supply gone. The IEA calls it the greatest energy challenge in the history. The ripple effect hits in three waves: energy spike first, then supply chain contagion, food prices, airfares, then core inflation locks in, and the central banks freeze. They can't cut without making inflation worse. World Bank baseline: the acute phase ends in May. Recovery to the pre-war shipping levels by quarter 4. That's the optimistic scenario. Stagflation risk and the 5.2% yields. Global growth is getting crushed between two forces simultaneously: soaring energy and the sticky inflation. BNP revised global inflation up by 1.1%, cost of capital 30-year Treasury at 5.2% and the highest since 2007, and 10-year is at 4.67%. Everything gets more expensive to the borrower. Growth gets revised down zero point 0.4 points. JPMorgan is now pricing in a 35% chance of a US recession. This is the stagflation trap, and that's no clean way out. Monetary divergence. In 2025, 70% of the central banks were cutting rates together. That coordinated easing cycle dead. In 2026, the Fed is frozen under incoming chair Kevin Hawass, battling 3% sticky inflation, resisting every pressure to cut. The Bank of Japan is hiking to 1%. The ECB is forced to hike because of the direct Hormuz energy exposure. Only the Bank of England is still cutting. Every major central bank is going through a different direction. The policy backstop that cushioned every market downturn since 2008 is gone. And now we are here on a 1.25 trillion debt mountain. US credit balances hit 1.252 trillion in quarter 1 2026, a 63% increase over 5 years. The consumer is entering this inflation shock carrying 325 billion more in revolving debt than any pre-pandemic record. And it's not evenly distributed. Connecticut and the New Jersey averaging nearly $10,000 per person. Washington balances growing 11.8% year over year. The consumer is highly leveraged and they are walking into an energy shock. Compounding pressures. The debt engine. 23.79% APR on a new credit card offers 1.25 trillion in balances. Real wages getting eroded by the food and the airfare prices. Here is the critical insight. A 30-day delinquency rate is 2.94% and declining. That sounds reassuring. It's not. Delinquencies are a lagging indicator. They only spike after the labor weakens. The cascade is delayed, but it's incoming when the job market cracks. And now, here why the market hasn't collapsed despite everything I just showed you. The AI supercycle, 13 to 15% above trend earnings growth projected for the S&P 500 AI sectors. Corporate capex is price inelastic. Tech, healthcare, logistics must spend on AI regardless of yields or energy prices. This is the FOBO, fear of being obsolete. You either build the infrastructure or your competitor does, and you are finished. And the benefits are broadening from the Magnificent Seven down to the next 493 stocks, driving 12% earnings growth through the operational productivity. Corporate balances sheets and the AI capex are operating in a completely separate, insulated economic reality. and they are single-handedly preventing a market collapse for now. Global reality. Not every region is getting hit equally. US low energy vulnerability from domestic sale, high AI catalyst but consumer is a warning and the fiscal headroom is low. Eurozone critical Hormuz exposure, but German infrastructure stimulus provide a buffer. Japan a high energy exposure, but the Sena economics is reviving middle class spending, and the Bank of Japan hiking is forcing a historical shift. Emerging markets stable at 3.3% ex China growth, mixed energy, low equity catalyst. Same collision, four completely different outcomes by region. Positioning for polarization. Where does the capital go? Equities bullish 10 to 25% upside, stay in a large cap growth and AI adaptation plays. Fixed income bearish, don't belong duration. 10-year base at 4.35%, but the vulnerable to 5.2% shock. Corporate spreads widening to 110 basis points. Commodities targeted bullish, gold to 5,000 by quarter 4. Brent base case is $58, assuming Hormuz resolves, highly sensitive to the conflict duration. Forex dollar bearish, euro bullish, euro USD target 1.2, GBP USD 1.36, and USD JPY is breaking 164. Now here we come to the resolution or the cascade. This is the 2026 ultimatum, and it's the only question that matters. Right now, two realities are running in a parallel, the macro and the corporate world thriving, AI capex, strong margins, stock market boom, the micro and the consumer world crushing. 5.2% yields filtering into the 23% credit card APRs, flat wages, and destroyed purchasing power. These two realities cannot coexist indefinitely. Either the Middle East conflict resolved by the mid-year, energy cools, yields drop, or the consumer gets relief, or the debt burden fractures the foundation of the AI equity rally. Two paths, one outcome, and the Hormuz resolution timeline is a single variable that determines which one plays out. That's your 2026 macro picture now. Which path are you betting on, resolution or the cascade? Drop it in the comment box. If this added value, like, subscribe, and join the Market Thesis community for full positioning with the specific names and levels. Link below. See you the next week.